Welcome to the Land to Lots podcast, powered by Launch Development Finance Advisors. And now your host, Carter Froelich.
Hey everybody, this is Carter Froelich with the Land to Lots podcast. Welcome back to episode 2 of my conversation with Kyle Thomas and Sam Hartman of D.A. Davidson as it relates to the launch bond. Obviously, the biggest thing that's been going on, and we've just been on the phone every day, multiple times a day, is the Texas MUD forward funding launch bond. So for our listeners, and let's just step back a bit, we all know what we're talking about, but could one of you give us an explanation, or give our listeners an explanation of what the MUD forward funding launch bond is?
Yeah, I'll take a stab at that. As the Texas developers and listeners will know and be very familiar with, is the use of a MUD as a tool to reimburse advances they make in putting in public infrastructure into the ground as they get their projects off the ground. And typically there's a standard process by which developers can, and the MUD can go out and issue bonds after homes have been put in the ground to be reimbursed. So that's typically been used, what we call as a reimbursement tool, reimbursement mechanism. And, it's similar in California as well, where in some of the states that we operate in, like Colorado and Utah, for instance, there's a broader use of an allowance for what the tools can do, where you can actually go out and issue bonds earlier in the process of a development and use those funds to capitalize work up front. So in the case of the launch bond, what the launch bond basically does is monetizes a future stream of MUD bond issuances. So it's a bond that gets repaid by future bonds, effectively. And what that allows for is, it allows obviously for capital to be brought forward in the life cycle of a development, which, I think what we've seen in the Texas transactions we've done, the last quarter, $400 million or something in that neighborhood, is because we could issue these bonds at tax exempt rates. We're able to be the low cost of capital for most developers as they consider their full capital stack, be it equity or private debt, or just wherever they're getting their capital. And so pulling this forward and replacing other forms of capital has been very accretive in the process.
The other thing I think that's worth adding is that these are tax exempt bonds, and there's a tax analysis that's necessary to be completed for these to be tax exempt. So the reason why this launch bond has been successful is that we have a great partner in the National Finance Authority that's been the issuer of these bonds. Mm-hmm. And their interest in participating in these projects is really accelerating the development of public infrastructure. Ultimately, to deliver houses, to deliver new commercial projects, there are public infrastructure requirements that in some cases can be incredibly complex to solve in the absence of these tools. And so by partnering with the National Finance Authority and by really reimbursing developers for public infrastructure that's benefiting their community, it's a powerful tool to be able to reimburse early on in a project for public infrastructure. So then that capital can be rolled forward into other projects, next phases of the project. But I think it's important to note that this is different than if you were to go get a construction loan for a bank, because of there are tax rules that we must meet. And we've diligenced this with Bond Counsel and the National Finance Authority. But it just wanted to note that this is a unique type of transaction because we are issuing tax exempt bonds.
Right. And some of our clients, and especially the ones in Texas that may be more familiar with the MUDs, they're going, well, how in the hell are you guys doing that? Because we've got certain requirements that we have to adhere to with the TCEQ, Texas Water Code, et cetera, et cetera. And Kyle, you touched on that through the talking about the National Finance Authority, but maybe to simplify it even more, if one of you could explain what actually we're doing, and then are we changing the structure that currently occurs in Texas as it relates to the MUDs?
Yeah. So first of all, MUDs are incredibly efficient. We just pulled up in Bloomberg the number of issuances over the last 5 years. There's more than 1,000 MUD issuances or water supply districts, or there's a variety of kind of similar sort of districts, infrastructure districts. Over 1,000 issuances and almost 7 billion in debt that's been issued over the last 5 years. We are not looking to change that market at all. Actually, we need that market to continue to be very efficient because that is the sole repayment source for the debt that we sell. So if a developer has a reimbursement agreement with one of these districts with a MUD, they are selling their rights to the MUD receivables to the NFA. Okay, so it's an outright sale of those receivables to the NFA, and then the NFA turns around and sells a bond to an investor, and the source of pledged revenue to that bond is these future MUD bond proceeds. So it's a sale and assignment of future MUD receipts, and once that bond is paid off, then the MUD can go back and continue reimbursing the developer for other expenses. So it's a sale, and then it reverts back to the developer once that debt has been repaid.
And I would add to that lenders taking a lean position on MUD receivables is not new.
Yeah.
Right? This has been happening in Texas certainly
For
before
a
we
long
started
time.
issuing launch bonds. Right? This is kind of normal course of business in the state of Texas. What's new about it is the ability to go secure, monetize this position on a tax exempt basis.
Yeah.
And so I think if you look at the advantages of kind of the unique features of a launch bond, it's one, this debt can be issued on a tax exempt basis, so that comes at lower interest rate. So the range that we've been issuing in is from like 5% to call it 6.25% in 2024. Obviously, rates will fluctuate. I think the second advantage is that this debt is non-recourse to a developer's balance sheet. And then I think the third distinct difference as well is that the maturity on these bonds, I think, is generally more flexible than a private lender. And so in Texas it'll vary. I don't want to get into the nitty gritty of the detail of the structure, but ultimately these bonds get repaid by the future MUD bonds over the next 5 to 7 years.
And a lot of off ramps there too, Sam. So I'm gonna follow up on that. So if I can just summarize, and here again, I want our listeners to hear this: tax exempt, non-recourse financing. And you had indicated this is nothing new. It's not. I mean, there were private investors. Everybody in Texas knows who they were. They're happy to take your MUD reimbursements off your plate for anywhere between 12 to 15% discount rate. And now the rates that we're getting 5% to 6.25%, or 6 1/8, somewhere in that range. Depends on where the MMD is. So the other thing is we're talking about MUDs. Kyle, you had indicated the freshwater supply MMDs. We can use this kind of financing for those types of districts as well. It's just not a MUD. And I just want to make that clear, correct?
Correct. Yeah. The distinction is that any district that enters into a reimbursement agreement can, ultimately what you're doing is you're selling that reimbursement agreement to the National Finance Authority. So this mechanism can be applied across a variety of different issuer types.
Yep. Yep. And then you touched on another thing, and that is we're pledging these future MUD reimbursements to pay back the launch bond over a term of 5 to 7 years, whatever it may be. What happens if it's not paid off at the end of 7 years or whatever the maturity of the bond is?
Yeah, so when we sell the bond, it has a stated maturity date, and as we've said, that's 5 to 7 years. At the maturity date, if the bond is not paid off, typically these have been sold with a default rate. So the interest rate on the debt might increase. Typically, it's been by 4%. That obligation remains for a period of time. There is a point in the future when the obligation is completely discharged and is no longer an obligation. I think what's important to note is if, let's say, you get to maturity and the debt has not been repaid, there's not an obligation of the developer to step up and make the bondholder whole. And actually, because of the tax analysis, we can't do that. So there's no land security, there's no obligation for the developer to pay. So it's really a matter of the investor waiting for the project to be successful for those MUD receivables to come in to then repay the debt. So there's not an off ramp, if you will, for the repayment. It's just a matter of waiting for those MUD receivables to come in.
And I would just add to that. So obviously, this is where structuring comes in, right? So the bond investor, buyer of the paper, they want the answer to that question as well. And so again, this is where it just pays to be consistently in the market to know where we need to be from a coverage standpoint. So, whether that's basically sizing our bond such that there's 1.x times coverage on the bond to allow the bond investor to get comfortable that this bond that they're buying will indeed repay by maturity is a critical question that has ramifications on the overall proceeds that will be generated by these bonds. And so that's one of the critical sizing factors that we look at and that we keep the pulse of the market on. I think one way the bond investors look at it, and so we run these sensitivity analyses as part of an offering, is, okay, here's the base case pace of your project as indicated by a third-party market study.
Mm-hmm.
What if the pace slows down so that the absorption is 50% of the base case pace? Will the bond repay? Right. And so we'll size a bond and show an investor that, like, hey, look, if this project slows down to half of its projected pace, you'll still get paid, by maturity, or your return will still be X. So those are certainly things that we really focus on.
And that helps the developer too, because in the back of their mind, everybody wants to pay off their debt, and we're building in that cushion to make sure that people can sleep at night. So absolutely. So, and a lot of our Texas listeners right now are listening to this and they're going, well, great. Thanks for all the fundamentals. Appreciate it. But when can I use this? And so I've got a project. It has a MUD, an MMD, freshwater supply district. If I come to you, Kyle and Sam and Carter, hopefully, don't forget me, guys, and say, we got a project. What does that project need to look like for us to be able to go to the market and issue a launch bond? Now, that's a very open-ended question. We'll start drilling down. And to our listeners, this is the time you get out your HP calculator, because there may be some math involved. So take it away, guys.
Yeah, go ahead, Kyle.
Well, I was saying, there's maybe two ways to take this. One is, what are the requisite components of a project to even be able to access the market? So that's kind of one question. Then the second question is, assuming you've met that threshold, what are the different credit characteristics of your project, and what does that mean in terms of execution? Mm-hmm. So in terms of truly just these are requisite components to be able to access the market is the MUDs need to be formed and they need to have ballot authority to issue debt, clearly, because that's the only method for these bonds to be repaid. From the legal standpoint, that's really the only hurdle. From the other credit components, there's certain aspects of the entitlement process that you need to be through to get investors comfortable. Basically, they need to know that if you're saying to an investor, I'm going to go build a master plan community with 2,000 units, that you have the entitlements in place to be able to do that. Now, does that mean you need to have all your lots platted? No, it doesn't. But investors typically don't want to take the risk that the local jurisdiction might say, no, we don't want 2,000 units. We want there to be 1,000 units. So there's some amount of zoning requirements you need in place to kind of overcome that threshold. I think everything from there on is really a matter of how do you get investors comfortable that this project is going to be built as you state, and what level of risk do they view the project having for the repayment of their debt. So if you look at that continuum, and if we just look at what we priced in 2024, there were bonds that priced at 5%. There were bonds that priced at 6.5%. And the reason why a bond price is at 5% versus 6.5% is because of where that project fits in the risk continuum. So for some projects are accessing the market, if you look at the source of repayment for the debt, the MUD bonds to be issued, the majority of those homes have already been built. It's just a matter of the MUD going and issuing those bonds over the next 1 to 2 years. That risk profile to an investor is pretty low. That's how you get a 5% coupon. We provided financing for another project. We did a $106 million bond for a project where nothing had been built vertical, and all of the funding that we were generating was going to build the primary infrastructure in the project. So the core spine road, a water treatment plant, wastewater treatment facility, some of the in-tract improvements. That's a much higher risk profile, and so that priced at 6.5%. So it's really a matter of when do you need the capital in your project and what price are you willing to pay, and then we work with the developer on iterating on, if you issue today, what does it look like? If your credit improves and you issue in 6 months, what does that look like? What happens if you issue in a year? And then you have to drop that into the pro forma and say, well, when is this most accretive to us to issue debt? Sometimes if a developer is IRR focused, typically the answer is we want to issue as soon as possible. We want to get this capital into our project as soon as possible. In other cases, developers are more focused on their multiple, and maybe issuing in tranches is a better solution for them. Maybe waiting a year is a better solution. That's all kind of part of the back and forth. Sam does a great job at that. In his prior life, he was a developer. And so that's, I think, some of the value add we provide is really helping analyze when is the best time to issue and how does this fit into your broader pro forma, because we realize there's not, one solution doesn't work for all.
Yeah.
And I think it might help just to give some really specific examples of the last 5 or 6 financings that we've done on a spectrum. Just jumping back to maybe taking your question in a slightly different angle, Carter, of like, okay, how early can you issue one of these bonds in the spectrum of a project life cycle, right? So Kyle hit on a deal that he led called Thomas Ranch, where it was very early stage. Something like 5% of the infrastructure was put in the ground. Right now, there were other credit features that had to be there for that to get done. Right, balance sheet questions and other questions all get put into the picture. There was a project we did for Bold Fox in the northwest portion of Houston called Atwater. That deal had no vertical construction yet in the deal. And in addition, there were 3 builders lined up to build those homes, award-winning builders in History Maker Homes, Chesmar Homes, and Empire Communities. And so that was a credit factor that was important in that instance to get that one done. So we worked on Valencia, a project for Hillwood. Again, that project was in the early stages, with homes coming out of the ground, all the way to maybe a more mature project in Highlands for Caldwell and their group, which obviously has several hundred homes in the ground, amenities in place, golf course, and so it really, you could really do it on a broad spectrum as far as life cycle is concerned. And then it's just some of those other credit features and other factors that would play into the price of the bond and the overall ability to execute on that bond.
Right, right. And if we're going to talk about, maybe we can give some, there's different bond structures. I don't know if we want to get into that level of detail as part of this conversation. Maybe we do a follow-up on a couple of the different structures that are available. But if we were to give our listeners in Texas a rule of thumb, and let's just assume for the first example, or maybe you want to take this a different way, in terms of cost in the ground versus revenue projections. But is there anything that you might be able to give our listeners as to, if I have $30 million in the ground today, how much money could I get? How long will it take Launch and D.A. Davidson to go get us that money? Or, what if I have 75 million in future MUD reimbursements coming back to me? How much can I get and when can I get it? I'm going to throw that out. We don't have to use those numbers, but to give some sort of metric or measuring stick to our listeners right now as they're listening to this. Hey, gosh, I could go get this amount of money and it takes us about 4 months to get it, given the various metrics of my project.
Well, my immediate answer would be just call us and we'll run the numbers for you.
Yeah, that's it. That's the easiest one. Yep.
Yeah.
And we will provide all of our phone numbers and contact information on the show notes to this. So our listeners, just go to the show notes.
I mean, I say that, but in all seriousness, it's really, it's something that we could turn around fairly quickly for listeners on the call to be able to do that. With all the advantages, of course, that we hit on earlier. Kyle, I don't know if you care to venture a heuristic on that or not.
Well, we can look at the transactions we have completed and the total reimbursable budget. So there's a certain amount that might be in the ground today. There's some that's coming, in the next 2 to 3 years. You take that total number and can back out what your proceeds are today. I would say, just as a rule of thumb, it's 50 to 70% probably is what's available today. I will say what changes that number significantly is the period of time that interest accrues on the debt. So if a project's building out in 2 years versus 7 years, that answer is going to be drastically different, because it's just interest accrual, right? So if these bonds are at 5% and you have $100 million bond, like, it's a meaningful number of receivables that are being used to service interest over that time period. So it does change that analysis quite a bit. But for your typical project, 50, 60%, I would say is pretty standard. We have to build a coverage factor in, and this was to Sam's prior comment. Like, everyone thinks they're going to build 500 homes a year, for 5 years, and we just know that doesn't always happen. Sometimes it's accelerated and you pay the debt off sooner. Sometimes it gets a little bit slower. So we have to build in some coverage, meaning that, likely by the time this bond is paid off, there's going to be some additional receivables that the developer will get back at the end of the project, and that's kind of the coverage factor we build in that can impact that upfront receivable percentage by quite a bit.
So 50
what
to 70%.
What I would add to that, Carter, really quickly is and we have like a 2-page primer that does a good job of explaining this. Is when Kyle's saying 50 to 70%, that doesn't mean you only get 50 to 70% of the MUD bonds that you would have otherwise received. It just, the way it works is we front a portion of the MUD bonds. You get it now, today. And then you'll pay 5 to 6.25% interest on that par amount we issue until that's paid off, and then you start collecting your mud bond receivables again. And so it's not lost, quote, lost money. Like the only money that doesn't flow to the developer that otherwise would have flowed to the developer is that interest component that that they're paying on the launch bond.
And so to our listeners, and to really simplify, what we're doing is we're moving those revenue events you will have received over the next 5 years to 4 months out from when we started. And Kyle, when you're saying 50 to 70%, is that 50 to 70% of costs in the ground? Is that 50 to 70% of the next 5 to 7 years worth of net mud bond proceeds coming in? Or is the answer to that yes on both accounts?
It depends. I would say in general, it's costs in the ground today
Yeah.
plus the next 2 to 3 years of costs is like a good rule of thumb for that.
And we've got some guys, and some of which have given us, hey, I've got a $5 million mud, and we've had to tell them, yeah, that probably, I mean, we could do it. It's just given the costs involved, it probably doesn't make a lot of sense. What is a good number for our listeners to be thinking of in terms of moving forward with the launch bond to develop those economies of scale?
Yeah, I mean, obviously there's a host of attorneys that get involved in a transaction like this. We are issuing a municipal bond to, there's securities laws around that, and so it is quite an effort to take one to the market, and that cost of issuance, the bigger the bond is, right, the more you can amortize the cost of issuance across a bond. I mean, the number that comes to mind for me is, I think a bond north of $10 million is going to make the most sense. I think we've done several transactions that are kind of in the 25 to $50 million range, which I think really hits a sweet spot for our clients. And then, I think we're working on some that are quite a bit bigger than that.
Yeah. Kyle, any thoughts?
I think that's right. It's important to note that for this to make sense to a developer, it's not just what is the coupon on the debt, right? That's a component of the cost, but you also have to look at what are the transaction costs and what's my interest accrual over time, and how does that compare to other alternatives that I might have.
Yeah.
And so something that we do is we're just very upfront and transparent, and we say, look, if you were to do nothing and just receive your MUD receivables as is, we can present value that stream of revenues. We can compare that to the launch bond and getting some proceeds up front and then some at the end. And you just look at those two streams of revenue and say, all right, well, what's my kind of blended, cost, if you will? And then you compare that to other options. So I think that's something that we really focus on. We've worked hard to try and make our transactions as efficient as possible to limit costs where we can, and just be mindful that this has an expense to it, and it still needs to pencil from the developer's perspective versus what the other alternatives are in the market.
And thanks. Oh, go ahead, Sam.
Yeah, and again, just from the first 10 years of my career, I was working for a family office, and we were a GP on several developments across the country. And just with that hat on, just knowing what I know about the equity and debt markets and this municipal bond market, is for most developers, this capital at this rate with these features is going to be attractive to either supplant equity or debt, or return, even return of capital. So I think it has advantages, and so I think that's why we've seen really kind of the level of interest that we've seen as particularly as the launch bond has evolved in Texas and even in other markets that we serve is how do you finance these capital intensive projects in the most efficient way possible to keep costs down and ultimately to keep housing affordable. And we care about, I'm passionate about that as well, is how do you finance all of this stuff in a way that's the most cost effective so that ultimately we can keep housing prices reasonable for folks trying to to buy their first home or move up home or whatever it is. And that's what really drew me to DA Davidson and really making the shift into this industry, is just recognizing really this is an extremely elegant solution to financing extremely expensive projects that ultimately has a downward effect on all costs, and I think including home prices. and so I think it's just a really unique tool in other markets, maybe outside of Texas, where I think the general thinking is, you have equity, you have bank debt. I think what I'd like to sit here and say, like, you have equity, you have bank debt, and you have special district debt. And the combination of those things drives down the weighted average cost of capital.
Yeah. Well, and then just to piggyback off of that, and this, I think I've said this before on our podcast, at launch, our mission is to be a hero to the development and home building communities. Period. End of story. That gives us a lot of leeway to help our clients. Typically, it's financing infrastructure, reducing costs, and mitigating risk, all with the goal of enhancing project profitability. And when a client comes to us, and Kyle, to your point, Sam, to your point, we lay out the transaction. We lay out the cost of issuance. We show everybody what this cost will be. We want you to compare it to your alternative capital sources, be it debt or equity. This has to make sense to you. We're not here to sell you a launch bond. We're here to help you solve a problem. That problem is typically in capital. Now, given the effectiveness of what we've been able to do, oftentimes this is the best solution, but not always. Here again, to our listeners, we're here to work for you to solve your problems. There are others that are running around that are copying us now that have at least 200 basis points that are in it for other reasons, but we're in it for you. We're here to be a service to you. And we're going to show you all the costs that are involved so that you can make an informed decision on, does this make sense for our transaction or not? And we're here to build trust and to have a long-term relationship with our partners, whether it's in Texas or anywhere in the United States. And I think I'm speaking for DA Davidson as well. We work with others as well, but as it relates to this in Texas, we're joined at the hip and lockstep in terms of what we're trying to accomplish for all of our clients. Any other thoughts on that? And I know we're getting kind of towards the end here, and we'll wrap it up here shortly. But any concluding comments or questions or comments we should have provided to our listeners to help them understand this opportunity as it relates to what they might be able to do in Texas?
Well, the other thing I'll add is sometimes we get asked, like, when should we talk to you? Like, when is it right for us to engage with a developer who's looking at a project? And our typical answer is as soon as possible, because if you have already invested in the project, put infrastructure in the ground, and then you come to us and we do a bond, that's great. We can do that bond issue. You are going to get a certain amount of proceeds and you move on. The developers that have done these bonds 2, 3, 4, 5 times, and it really clicks with them, they come to us when they're underwriting the original ground and say, help me plan out when I can do these bond issues. And does that, having that level of understanding, does that give me the confidence to be a bit more aggressive in what I'm willing to offer for the land? Does that plan change how I'm marketing my lots to builders? And so where we really can provide value is helping in underwriting a project. So that way you are successful in bringing that project in and executing, knowing on the back end that you're going to have these public financing tools in place to be able to execute.
And I'd like to follow up on that. And right now, having been into this, I mean, into the minutia of these agreements and the side agreements and the builder agreements and you name it, we have to be 12 steps ahead. So bring us in sooner rather than later, because you're going to want to refinance. You're going to want to finance an additional MUD. You're going to have to other regional infrastructure. You may be annexing land into a MUD. We need to think in terms of chess rather than checkers, and we need to be way ahead of the game so that we've got, we know on this project we're doing the end around. This one we're going right up the middle, and on project 3 we're throwing the long bomb, because every project is different, has different infrastructure needs, different credit qualities, different builders, and so one size does not fit all. And that's the thing I'd like our listeners to hear. Call us sooner rather than later. We'll be here 25 years from now. And for all of our listeners, I'm living to 126 and I'm never going to retire. So I'll be here. Call me. I'll give you my cell phone. It's on the show notes.
Well,
Sam, you wanted to say something.
yeah, well, a couple of things. I really appreciate what you said, Carter, about how you're trying to solve problems for your clients, and I think that's what makes us such good partners. Is like, I do think that we just have a sincere desire just to help our clients and collectively, and so that's what we like to do. And from a pure brass tacks monetary standpoint, we don't, as an underwriter, we don't get compensated unless we've succeeded in providing a bond to you, right? So call us. We'll help through the whole process. That's all on the come, right? Because at risk, because we believe in our ability to provide solutions and succeed.
Mhm.
And so I think that's a little bit just something for folks who again might be deliberating on
Mhm.
when to reach out.
And have we ever had a hiccup in selling a bond in Texas?
No.
Yeah. Have others?
What?
I don't know if I could ask that, but I'd love to.
It's not is the process easy? The answer to that is unequivocally no. The process is detailed, and there's a lot of minutia, and the working group is, there's probably 20, 30 different people involved in bringing one of these things together. So on that point, yeah, and every deal has its wrinkle, right? And so I think we pride ourselves on just being super responsive, and tackling challenges as they come in a deal. I think to answer your question, have we ever gotten to a pricing day and not been able to execute? The answer is no.
Our desire is to be a long-term partner. The clients that we work with are not single serve clients, right? And so we know that we have to serve their long-term needs, and they'll choose to come back and work with us time and time again.
Yep.
And so we're looking for partnerships. We don't work with every client that comes to us, right? Like we choose a client just like they choose us, and we're looking for good long-term partners. We want to invest in their projects.
Yeah.
And our credibility is on the line, right? With each project that we sell debt for, if that project does not function and perform, investors look to us and say, "Hey, what's going on here? What's the deal?"
Yeah.
And so we really value working with clients that have a similar mindset of just delivering high quality projects, bringing down the cost of housing, and really being a solution in the market.
And I don't know where this fits into this call as well, but I'll just I'd like to mention it is we can say a lot of nice things about our company. We believe in ourselves. We believe in our company. But what I really try and when I have a conversation with someone, what I really try and point them to is publicly available data that allows us to show ourselves relative to the rest of the market. Because I want you to believe what I'm saying, but trust but verify, right? I want you to look at the actual numbers, and you could pull numbers from Bloomberg and other sources that we pull to allow folks, again, in this manner of transparency, like here's the data, here's the market, you make the best decisions for you. I was having a conversation, ad hoc conversation a couple of days ago with, this is specific to Texas, with a developer builder who is in this process of a forward financing bond. They had chosen another underwriter, and there's been challenges, bumps in the road, and I don't know all the details, but they were calling us to get some help. And my thought to that was you really want to have a partner that's been through it before, right? And has the reps to know how to structure it the most efficiently and avoid the landmines that exist, and has run the traps. And so the thought was, if you need open heart surgery, it's nice for some surgeon to have his first surgery. You just don't want it on you. And so you want someone that's been through it a couple of times to give you some comfort that it could get done, and that surgeon could go do his first surgery on, or her first surgery on someone else. And so, I do hope that in that instance that we're able to ultimately help that client, and I really hope that transaction is successful. But we do, we do lean on our experience, not only with the Texas launch bond, but that's all backed by years of experience in the non-rated bond space across the country. And this launch bond in Texas falls right into that vein. And so a lot of what we've talked about in this call about our sales desk and so forth, like we've been at this for quite some time.
And one last comment to our listeners before we sign off here today is we're always looking at ways to create efficiencies of scale. So if you have multiple MUDs, we are able to roll those up into a single transaction, whether all of the funds flow to the same investor mothership as it was in the Starwood transaction that we took care of at the beginning of the year, or if you have multiple different investment partners that are in different projects, different MUDs, we've developed a means by which we can roll up those types of transactions and determine who gets what funds when, as it relates to costs in the grounds, costs to be put in the ground, and what the revenue projections are looking at. So we have a lot of different tools that we can utilize to help you solve your financing needs. So with that, Kyle, Sam, I want to say thank you for taking over an hour of your time today to speak with us about the municipal debt market, unrated transaction market, as well as the launch bond, and look forward to chatting with you later.
You have been listening to the Land to Lots podcast with Carter Froelich. Follow us wherever you find your podcast to never miss a new episode.